Morgan Stanley is betting big on India. We already heard that from Rhythm Desai on this channel. He told us that they expect India's GDP to cross $7.5 trillion by 2031 and the market cap of the Indian equity market to touch $10 trillion. Big growth expected in the next 8 years. To explain the economic rationale behind this very bold bet, I have with me today Morgan Stanley's chief Asia economist, Chetan Ahya. Chetan, good morning and thank you very much indeed for joining us. Can you begin by giving us the economic rationale for expecting that India would be the third largest economy and a $10 trillion economy in the next 8 years?
Yeah, Lata. So I think the key argument that we have is that there is a big shift in the policy approach that the government is making in India over the last 3 years. And this has been a concerted action since, I would say, 2019, where the government is more focused on job creation and less focused on redistribution. And for efficiency of redistribution spending, we've got the digitalization that is helping the government to reach welfare spending to the needy, and therefore, in some ways, making the whole public finances management more efficient. But this big picture policy shift that is happening in India is something that, having tracked China for so many years, I was also kind of, always comparing India and China, is that China manages social stability by focusing on job creation and private investment. But India was taking up a more balanced approach and focused a lot more on redistribution related to job creation. But the shift that is happening now is that focus on private investment and job creation is the biggest reason why we are making this call. Okay. And then the second reason is that we think that there is also a change that is happening in terms of the dynamic of India's exports and global market share in goods exports and services exports. In the services exports, we are seeing that pandemic has actually meant that outsourcing is increasing from India, and India's market share in in services exports has gone up significantly. And at the same time, this shift and focus towards private investment is going to help increase India's market share in manufacturing exports. And this story is also similar to China's, as well as the other East Asian countries like Japan and South Korea, where they focused on, in the initial phases of their growth, they focused on exports, which always helps boost private savings. And that can be recycled and rechanneled into infrastructure investments. Okay. So we think that India is also embarking on something similar in terms of approach to lift saving and investment through that targeted approach to boost market share in goods and services exports.
Okay. I read this argument and, let me tell you that our viewers, all of us are emotionally on that side of the fence, that this is going to be India's decade because of demographics, because of decarbonization, renewable energy, freeing us from the yoke of depending on expensive crude or at least volatile crude prices. All those are very convincing arguments. If I'm going to throw challenges at you, it's more because I want to want to pass your argument through a stress test. Now, the first challenge is the near term. India's near term has always been struggling. Medium term has always looked brilliant. At the moment, rural demand is a big issue. All the FMCG companies that announce numbers have told us, today we had Bajaj Electricals, we had Relaxo day before yesterday, we had, Godrej today on the channel, all of them saying that the bottom of the pyramid is simply not consuming, rural demand is absent. So, how do you ensure that the bottom of the K becomes a big consumer, or do you think we can grow despite that?
No, I think bottom of the pyramid has to come through. And the way it happens is that if you just go back to 2003 to 7, we did it in India. And the way it happens is when you boost private investment and you create jobs in the urban economy, that filters through to the rural economy. And at the same time, the government needs to take up more reforms to boost productivity in the farm sector. So both the approaches have to come together. But it is very important to create jobs in the urban economy. Then only you will see that migration and transfer of workers from rural India to urban India. So no, it's not that we are making a call that we are going to see this progress at a macro level without the bottom of the pyramid benefiting. In fact, the bottom of the pyramid will be the biggest beneficiary now going forward, because if you look at India's investment to GDP, it has been declining. We had a nice run between 2002, 2003 to 2008. And after that, investment to GDP has been declining. And what we are making as a call is that this investment to GDP will rise back again. And that's at the heart of the overall broadening of the economic growth benefit to middle class as well as the bottom of the pyramid.
That you took away my next question. That was going to be my question. That with investment to GDP declining, and now in the high 20s or a little above the mid 20s, even if you take an incremental capital output ratio, ICOR of 4, we don't go above 7% growth. Then how do you get this this big number of 7.5 trillion?
Well, so no, it's on the basis of GDP compounding on a high base. So look, I know while you said that there has been sort of underperformance from India in the past. Well, despite that sort of less than satisfactory investment to GDP trend, India's GDP has grown up to $3.5 trillion now, and that's a sizable base. And one of the points that I have made in the report is that, look, the power of compounding on a high base is that, India took about 31 years to add $3 trillion to its GDP. But the next $3 trillion will be added in the next 7 years. So last $3 trillion was 31 years, next $3 trillion would be 7 years. So I think that's how we're making the call. And look, we are not forecasting growth rates to be higher than 6.5, but 6.5% real GDP growth on this size of GDP base is what helps us get to that about $7.5 trillion that we are forecasting.
Well, this is an age-old arithmetic, isn't it? If you grow at 7% for 10 years, you double the principal, right?
Yeah, so Lata, if you wanted to be skeptical, you could basically say that, look, this is now a pretty reasonable size GDP.
Yes.
And it would be difficult for India to grow at even 6.5%. So you could be, skeptical on that growth number. Yeah. But that's where we are also making that call and sticking our neck out that, look, despite the fact that GDP has grown to be a reasonable size, India will still be able to compound at 6.5%, which will be the fastest, for that 10-year period that we are saying India will grow at 6.5%. We are forecasting China growing at 3.6%. So you can see how the next attractive emerging markets growth rate will be compared to India. So 6.5% is I think already a pretty significant number that we're looking at.
6.5 we would take with both hands. And China did it on a large base through the 90s and the 2000s. It grew in even double digits. So, it's been done before. And we should do it. We owe it to ourselves. The other doubt I had, and you also raise it as one of the risk factors, is exports. Now, given the way Europe is going and even US by policy designed to slow, and China is slowing probably because of policy missteps, if you take away 3 large economies as slowing, US, Europe and China, then do you think the export piece becomes a big problem? Already, August, September, our exports have been falling or at least plateauing.
Yeah, so I think in the near term, exports will be weak. And so for that reason, because we are expecting global growth to be weak, we're expecting DM growth to be below 0.5% in 2023. This will mean that exports for India and rest of the region will be weak. And that's the reason why, Lata, for the next year, we are forecasting GDP growth at 6.2%. So in the next particular calendar year, there is going to be some challenge to achieve high growth rates. And we've built that into our numbers. And we are expecting the exports trend to improve from the second half of next year. But the year as a whole will still be relatively weak. And then it's only that from 2024 that India resumes and reaches its growth trend back to that 6.5% that we are forecasting.
Actually, at the moment, Reserve Bank is standing at 6.2% for next year. IMF is at 6.1%. I know a couple of economists in India, well-regarded ones, who are at 5.9 for FY24. What's yours?
So for FY24 is where I mentioned we are at 6.2%, Lata. This 12 months and March 23, we are at 7%.
All right, got that. Chetan, I wanted some of the more near-term issues as well discussed. What's the Morgan Stanley US or global view? Do you think we have seen the strongest of the dollar strength? Do you think the rupee has seen its worst? Do we expect a steady run from here on?
Yeah, so Lata, what we are saying is that, that now we think that the Fed rate hike expectations that are there in the market pricing is already a bit higher than what our forecast is.
Okay.
And on the back of that view, for the Fed outlook, our global macro strategy team has made the call that they are neutral on the duration, i.e. they are not wanting to be short treasuries anymore. And at the same time, they have turned neutral on the dollar, that they think that, bulk of the run in the dollar is done. And then over the next 3-4 months, they see that transition where dollar begins to weaken. So if you put that picture in mind, we think, bulk of the depreciation pressures on the rupee are now behind us. Having said that, the near-term data points are still going to be a risk to look at until the year end. And that's, we're going to get the US CPI inflation on 10th, that is tomorrow. And then there is going to be 2 more, prints, one for jobs, one for CPI before the December 14th or 15th policy meeting that the Fed is going to hold. And so, in the near term, Fed's hawkishness is still connected by the data points on inflation and jobs. And those are something that we are watching closely. But we do think that bulk of the pressure of depreciation on the rupee is now behind us.
Okay, that's also good to hear. That volatility was a bit disturbing. Then a word on what a Reserve Bank might do. This pressure of a hawkish Fed, do you think that can keep the Reserve Bank on its toes? What's your peak repo rate expectation?
So we are at 6.5% peak policy rates. We think that the RBI will step down in terms of the magnitude of easing that tightening that they're taking up to about 35 basis points in the next meeting, and then get to 6.25% early next year. So that's the forecast that we have. I think the Fed's policy rate hike expectations, if they have sort of peaked, that will reduce the pressure on RBI, because we also think that the currency depreciation pressures will reduce from the external side. And on the domestic inflation outlook, we expect it to get to around 5.5% by second quarter of next year, the April-May period. And so therefore, that just also reduces the pressure on RBI to keep going higher than 6.5% that we are forecasting.
Okay. Yeah, I guess the market consensus is between 6.5 and 6.75. Out of time, Chetan, but thank you very much for leaving us with a very optimistic feeling. There are near-term blues in terms of, global recessionary conditions and the Indian rural or bottom of the pyramid piece not working. But the Morgan Stanley view is that all this will be pole vaulted by the time we come to FY24 and FY25, and a longish growth period of 6.5 should take us to a 7.5 trillion economy. We are waiting for that. All our stakes are in that. Thank you very much for watching this edition of It's the Economy. Chartbusters coming up next.
Brought to you